I would call this sort of phase two of Peter. Peter, did all those seminars, I think about 2 or 3 years ago, and, sort of, I think, convinced us all about, that real estate investing can be good. And I'm just going to give you just a very practical step-by-step of what we did and why we did it. Not with the intent to say, oh, look at us, here's what we did, but just with the intent just to give you an example of what doing proper real estate investing can mean for your life. Not in the short term. It's not a get-rich-quick scheme, but it is a great way to build wealth for yourself into the future. Why are you smiling, Mark?
You lost me. It's not a get-rich-quick.
Okay, all right. Okay. So let's go to the first slide.
Good. Wayne, would you mind just standing?
Okay, so first of all, this is just a quick summary of everything that you guys know, but why invest in real estate versus anything, stocks, bonds, anything else you could be investing your money in? And really, real estate investing builds wealth in 4 ways. Like by doing it, you get all these income streams that you're not going to get anywhere else. You get property appreciation if done well. You get free cash flow each month if done well. Very hard to do in the Toronto GTA. You get mortgage pay down each month if you've got a mortgage on the property. And you also get incredible tax savings through depreciation and other write-offs that you're not going to get with any other investments, which puts more money in your pocket as well. So no other asset class comes close to producing this than investing in real estate. So that's the first thing. And we're all real estate people, so we understand that. The next slide is, no, keep going, but go back. Why we chose to take the plunge? Because I know for a lot of people, it's a lot of work initially, and there's a lot of fear initially to take that first step. You're getting a mortgage, and what about tenants, and what can go wrong, and we all go through that. So you have to have a strong why of why you're going to start doing it and why you're going to put in the time, because it does seem like a lot of work for not a lot of money up front. But over time, it really does start to produce some things. So for Hillary and I, first of all, it was lifestyle. We wanted to have a steady income outside of real estate sales so that we could, if we wanted to, take off 3 months and know that money was coming in and not have to worry about doing another deal. The second thing, too, for us is that we wanted to be an example for people to say you can do it and hopefully lead the way for them to help. And our tagline in our business is helping people move in the direction of their dreams. And part of it, we believe, is not just helping them buy and sell homes, but helping them also invest wisely as well. And we wanted to be an example for that because, particularly as a real estate agent, if you're going to tell people about investing in real estate, the first question they're going to ask you is, well, what are you investing? What have you done? And if you haven't done it, why would they? So that was the other. And then the other thing is legacy. We wanted to build wealth in an asset base that could be used to help others, and also to provide for our children and grandchildren, that there's something there, because money can dissipate pretty quickly. So if you're building an asset base, it really is a good opportunity to leave a legacy. So those were really our 3 primary motivators for wanting to begin investing. So what did we start with? So at the beginning of 2012, we had no investment properties. I had a corporate job, and I just assumed, and I was as risk averse as anyone, making good income, stock options, and that all came to an end. And that's sort of what got me thinking, I've got to do something else for a pension or something, because what I thought wasn't working out. But we really had done nothing. And like most, we had some RSPs, but no liquid cash. But we did have a paid-off home that we took a line of credit against. So that's where we started from. We said, we've got this huge asset here that we can leverage a little bit better than the 3% or 6% growth. You still get the 6% growth. So we took a line of credit against the house as a beginning, and then we attended Peter. It was all kicking off with Peter, and we had that that meeting in your office as sort of a starting point. So keep going. So that's what we started with. So basically, next slide. So our initial plan, we took a line of credit, and I started looking around, and our initial plan was for acquiring properties was to focus on the U.S. market. And the only reason for that is Toronto was just crazy, and our primary objective with real estate investing was cash flow. Because we wanted to get to a place where we didn't have to rely on our real estate, we could go away and we were getting cash flow. And there was no way you could do that in Canada, particularly the GTA. And at that point, particularly in 2012, the U.S. market was such a compelling market for a number of reasons. One is everything runs in cycles. They were at the bottom of the real estate cycle, so you know that the market had only one place to go, was up. Secondly, it was just sort of an historic time where the Canadian dollar was at $1.02 versus the US. So you could go in at a historically high Canadian dollar and buy it at a historically low U.S. retail price. It was just a really nice confluence that it made sense. And then in the U.S., unlike anywhere else, you could get cap rates of over 10%, which is a near impossibility in Canada. And what I mean by a 10% cap rate means that whatever you pay for the property, call it if you pay $100,000, after all of your expenses, management fees, property taxes, insurance, repairs, you're still making a 10% return. You're still making $10,000 in cash flow on that $100,000. That's what you were dealing with. It was like, from a Canadian standpoint, it was like, how could you not, want to do that? So we started looking at the U.S. market then, saying, where should we invest? So the next slide is, we wanted to look for markets in the U.S. that, one, had a growing population projected for the next 10 to 20 years. That was very important because that was going to lead to appreciation. We wanted a diversified economy to ensure that employment was not going to be just dependent on one industry. You didn't want like a Calgary or something where it's totally dependent on the oil or whatever. We wanted a market where prices had yet to recover from the 2009 recession. And in 2012, I don't know if you remember, but Phoenix had gone through a dip, Florida had gone through a dip, California, by 2012, they'd already begun to resurge, to come back. But there were some markets that were still a little bit late in that cycle, some of the B markets. And we wanted a state that was relatively landlord friendly, so there'd be no issues with tenants or that they could be dealt with quickly.
Unlike Toronto.
Unlike Toronto and a lot of other states in the US too, if you want to get into it. And then we wanted, this is Peter's term, or at least I got it from him, seventh level investing, which is a trustworthy on-the-ground company that would manage everything. All we would do is make sure the checks were in the account every month. And they would look after tenants, putting everything in place and all that kind of stuff. So that was our criteria. So after sort of doing a whole bunch of research, we landed on, next slide, Atlanta. And the population there was expected to grow by 500,000 people by 2020. It's home of all these Fortune 500 companies, so it had a really nice diversified employment base to it. And interestingly, in Atlanta in 2012, home prices were still at rock bottom levels. They hadn't come back at all like some of those other markets. It was sort of a B market that had been overlooked. And it had one of the most favorable rent-to-price ratios in the US, meaning you could get the highest returns relative to what you paid for that price anywhere in the US at that point. And it's very landlord friendly. You can get evictions in 30 to 45 days. Once they haven't paid, they put it in, they get the sheriff, they get them out. It's a wonderful state if you're a landlord, unlike New York, Michigan, California, which are horrible. So all of that lined up to say Atlanta's a great place. So here's what we did. Next slide.
No, this
Oh, I'm sorry. Oh, sorry, Atlanta strategy. Sorry, I was going to get right into homes. So we invested in blue-collar neighborhoods that had decent schools and low crime, because you want to be in sort of that sweet spot where you can still get high rents, but not pay too much. So if you get into like white-collar neighborhoods, you're going to be into 200,000, 300,000, 400,000. You can't get the rents to get those 10% cap rates. But the same token, you don't want to be in slums where there's guns and drug deals going on and it's high crime rate and no one wants to live there. So you sort of find that blue-collar sweet spot where it's upper blue collar, where they still have decent schools and relatively low crime. You're talking the US, it's not Canadian standards, but it's like US standards. The homes were all relatively new, all built after 1999 and situated on nice lots. And then we found a good company that provided a turnkey ownership system. So literally they sourced and rehabbed the homes and put in place a 1-year repair guarantee. So that was all looked after. Everything had been done, ready to bring them in. We screened for tenants, and that they would do this, and basically all of these tenants that were brought in had never had an eviction, a bankruptcy, and they had to have provable earnings of at least 3 times the monthly rent. So that was sort of the standards that they screened all the tenants with. And then in Atlanta at this time, the company we were working with signed them all to a 3-year lease. And they put in an option to buy, which was like a 70% premium to what they paid for it, but at least it was there. And it gave them sort of the incentive to treat it like an owner, which I thought was great. So you've got locked-in tenants now for 3 years, and you've got an option to buy owners. So I thought that makes sense. I don't have to worry about tenant turnover and stuff like that. At least I get a 3-year window. So that's what happened in Atlanta. So with that in mind, this was the first home we bought. 175 Rivercrest Lane in Covington, Georgia. We paid $102,000. Now that's US, but remember that's at $1.02 Canadian, so that's like 100,000 Canadian. A 2,400 square foot, 5-bedroom, 3-bathroom house, double
Backing
car
on her
garage,
feet.
backing onto forest,
A third of an acre.
on a third of an acre on a nice lot. That's what you were getting down in Atlanta back then, built in 2006. And for that house, they'll pay, I got rent for $1,200, locked in for 3 years. Now, I can't for the life of me figure this out. It doesn't make any sense to me. Think about that. That's a $100,000 house. Back then, to get a mortgage on that, even at 4%, it's less than $500 a month. Your taxes and insurance are about $150 a month. You could own that home outright for $650 a month, but yet someone's going to pay me $1,200 a month to, to rent and stuff. But that's the market that you had down there, which is just crazy by Toronto standards, but that's what you're dealing with. So the total expenses per month on that house is $323 a month. So your gross profit is $877 a month. And then on the financing, because I took out a 3.5% line of credit, which is what it was back then, my financing cost on that was $298 a month. So in that house, I'm netting almost $600 a month free cash flow in US dollars. So that was the first home we bought in June 2012.
What piece of that goes to the,
I'll talk to that to the government.
go to
Management
the
company.
7th level company?
Okay, so here's how it all works out. So here's the $323. The management company charges a 10% management fee. Okay, so that on the $1,200 a month, the management fee is $120. That's the 10%. Taxes is $1,453 a year, or $121 a month. Insurance is about $500 a year, $41 a month. And repairs, I put in about $41, but it really hasn't been that, or about $500 a year for different little things. But I put that in all my homes. So total expense, total expenses is that $323, which gets you down to that $877 gross profit, or $10,000 a year, and that's your 10.3% cap rate I was telling you about. Then take off your financing. Your cash flow is almost $7,000 a year for just that one home.
Can I
So-
just make a question?
Yes.
So I own property in the States as well, and then there's a government fee that you have to pay every year and accounting fees. Did you account for that anywhere? I might be
Yes,
thinking
you know
ahead.
what, in these repairs, my accounting fees, I sort of initially right now, because you can put in vacancy and all that kind of stuff, which can take it down, but I haven't had any of those issues yet in 3 years, but there will be some of that coming in, but still, this just sort of gives you an idea. My accounting fees are about $200 a home averagely, and it's even, the more you buy, the less it is. It's like my accountant charges $395 per home to file both state and federal, and then $75 a home for every home after that.
And are you paying a tax, a municipal tax or a federal tax for that?
You pay, when you do it, I'm at a place now where I am paying some federal tax and a very small state tax on an annual basis. But there is tax harmonization, so any tax you would pay here,
It's offset here.
it's offset here as well. So
You're not paying double tax. That's
you're
the
not
point.
paying double tax.
And I think people that don't understand the process, I mean, I've been through this process for over 20 years, so I completely get it. I just want to make the point, though, that Canadians that don't do this, they think, oh, I gotta pay the state tax, I gotta pay the county tax, I gotta pay the
Yeah.
county, I gotta pay for the US tax returns. Net, this is net of all this.
Yeah.
Okay, so understand, you're not paying 1 cent extra in US tax when you structure right.
Yeah,
The
and he's
people
right.
that pay the double taxes because they didn't structure right.
That's
Yeah.
true.
So just, if you need to know how to
I'm
structure
just saying
right.
factored in
Yeah.
when you're
Yeah.
seeing what your
understand.
actual return on investment is.
Folks, we should let him finish.
Yeah, so let's just keep going.
going.
So this is the journey. This is the first home, and I broke this one out just to give you an idea. I'm not gonna go through it with every home. Okay, next home. This one we bought, this was a home we bought in June 2012, 420 Pebble Boulevard in Covington, Georgia. It's a 3-bedroom, 2-bath bungalow, 1,700 square feet. We paid $84,000 for that one. So that one you get $1,000 a month rent, expenses are $260, the gross profit's $740, you make $500 a month cash flow. It's beautiful, it's a beautiful home. Next one. That September then, we bought this 309 Vineyard Ridge Lane in Griffin, paid $86,000 for it. Beautiful home, double car garage, $1,000 a month rent, $450 a month US cash flow, okay? So that was 4 homes in Atlanta, keep going.
That's the next one.
Oh, 4th home, sorry, was Shadowbrook Drive in Loganville, Georgia. We bought that in December then. It just seemed like such a good deal, and I wish I would have even bought more at the time. That was
Can you just
100.
repeat that last sentence?
I wish I would have bought more.
More.
Thank you.
Yes.
Thanks,
The purchase price was $111,000. We're getting $1,100 a month rent, and again about cash flow of about $441. 1,900, almost 2,000 square foot, 3-bedroom, 3-bath home. Okay, so, and these are all newer homes that have been refurbished prior to tenants, coming in. So next slide.
Wayne, be careful not scratching the screen.
Oh, I'm sorry. So I just wanted to give you an idea of where these homes were though. So here's Atlanta proper. So these are almost, so this is two of our homes we bought here in Covington. It's about a 40-minute drive to downtown Atlanta. So they're sort of the outer suburbs. It'd be like, the Berries and of sort of the Atlanta area. But in the US, everything's very sprawling anyways. And they always have the big lots and stuff. Then one of the homes was up here in Loganville, which is a little bit of a nice area, and then that other home was in Griffin. So it just gives you an idea where it is in Atlanta, all sort of in the southern or east part of Atlanta. All the rich suburbs are sort of in the north, Alpharetta and places like that, Marietta, and places like that. So just to give you perspective. So next slide. So here, by 2013, our investments were yielding $2,000 US per month after all expenses. So literally those 4 homes on my line of credit cost me $383,000 Canadian. Okay, I was bringing in $4,300 a month US rent. My total expenses were $1,200. So the gross profit was $3,000 a month. After financing about $1,100, I was bringing in $1,981 US with the purchase of those 4 homes. Okay, so let's keep going. So here's what we did. So that was 2012. We did that. And then in 2013, we bought a townhouse in our Oakville neighborhood at 74 Normandy Place. So this was a home that we bought for $427,000. So you can tell the difference. So this little townhouse was now costs, what is that, $50,000 more than the 4 homes that I just bought in Atlanta.
Yeah.
But anyways, the advantage of buying in Canada at least was that I can get leverage and get financing here, where those I was buying straight cash, right? But my rent is $2,000 a month. My expense is about $295, so gross profit's about $1,705 a month. The financing is about $1,052, but I'm still cash flowing $655 a month on this townhouse.
Wow.
Now what I did on this, the Royal Bank let me do, is that the financing on the townhouse, 65% of it was line of credit, so it's interest only, and 15% was mortgage. So there's a very small part of it's mortgage, which because of that then, all I'm doing is, this could have been mortgage pay down rather than cash flow. But again, I was more interested in building up cash flow at the time than I was in terms of mortgage pay down as an example. Jonathan?
So insurance and taxes were less than 300?
A month.
Yeah.
Yeah, for sure.
Wow.
The taxes on this is, I just had it, $2,500 a year.
Wow.
And it's about a 30-year-old townhouse. So I always find whenever properties lag, they're older and stuff like that, assessment doesn't catch up to it.
That's
So
fast.
so literally the assessment is probably at about 60% the value of the property. So you're paying much lower taxes than you ordinarily would. And then because I use the same insurance company as on my home, the insurance on this only worked out to about $400 a year, because it was sort of an incremental home. You get a big rebate or something, which ordinarily might be like $700 or $800. So that's why it was a little bit less. Now I had to come up with an $85,000 down payment for that. So that wasn't, and we just sourced that from the U.S. cash flow and from business savings, like, from some of the money. That's how we funded it. But the reason we bought this townhouse, next slide, is it was located right in the heart of Kerr Village, which is a major transition, and there's significant opportunity for appreciation. We live right in there, and it's sort of an older neighborhood of Oakville that they're just starting to build $1 million homes and put in condominiums, and there's little cafes and stuff starting to open there. So it was a really a good place for future appreciation. And the townhouse, unlike many in this complex, had already been converted from electric baseboard heating to forced air natural gas, which was like a $20,000 change to do it. They'd already done it when we did it, so to me that made sense. It was a 3-bedroom, 2.5 bath, which is the sweet spot for rentals. Everyone wants that. And there are very few rentals within walking distance to the lake in downtown Oakville. Everything's sort of in the north because the south is so expensive that the demand for tenants would be high. And basically it's located less than 200 meters from our place, so it's easy for us just to sort of, look after. So that was the reason we bought that. It just seemed like the right thing to do. Yeah, we got it at a good price. Yeah. And then also, when I first we purchased this in in May of 2014 then. So in 2013, we just bought the townhouse. Last year, we bought this in May, and it was a 1-bedroom plus den, condominium, and this is just a new condominium that was going up in our neighborhood as well. And this is one, it was just a straight mortgage, you bought it for $321,000. The rent pretty much covers all the expenses. It's like a $3 a month cash flow. So it's cash flow neutral, but I'm getting like $6,000 a year of mortgage pay down, and I'm in a good market where I'm getting appreciation. And basically I bought that pre-construction back in 2011. So we just sort of finally took possession of it in May of 2014.
You know your maintenance fees are doubling in 2 years, eh?
Well, and I'll probably have it sold within
Okay.
by then too.
You've got an exit strategy on that one?
Yeah, like basically I'm not a big fan of condos. So I'm gonna sell this if I can, hopefully take the money from that and buy another townhouse in that complex, into the Normandy complex, because we've got some ideas for what we want to do there. So,
Did you figure out the cap on that? That must be like 3.5, maybe,
on which?
on the townhouse.
Oh,
Can't
the-
be much more than that.
400,000.
Yeah, no, it'd be about 4.5.
Really?
Yeah.
That high?
Yeah,
Okay,
yeah. No, you know what, no, you're right, about 3%.
yeah, that's what I thought.
Yeah, yeah. It's
more
GTA,
for
GTA
appreciation.
right
No,
now,
it's
Toronto
like some
GTA,
other
it is so hard to do what we're able to do in Atlanta. Okay, so next slide. So why do we buy the condo? It's located right off of Lakeshore Road, within walking distance to downtown, and it's in the midst of a new $1 million detached homes and townhouses. It's called the Royal Oakville Club, just kitty corner. It's 124 single detached and townhouses, starting at 1.1 million, going up to 2.8. So it's just sort of kitty corner from there, right in the midst of Oakville. And we put the deposit on the condo pre-construction in September 2011, and it should appreciate nicely, and it's less than a kilometer from our home, so it's easy to manage as well. And I've got the perfect tenant. It's this 30-some-year-old professional woman who's got a cat and loves it and just pays the rent, and I never hear from her.
What is the cat activity?
Because she's a cat lady and she'll never have a boyfriend.
Okay, keep going.
Ain't that the truth?
So in the spring of 2014 then, we began looking for other opportunities in the US. And the Atlanta market had increased so much that we were no longer able to achieve the 10% cap rates that we wanted. Because we got in 2012, like right up to December, and that was around the time that the big hedge funds started buying the huge properties and started entering the Atlanta market. So we got in just before that. And that's when they were starting to buy thousands of homes, and Atlanta was on the radar for the same reasons that I just showed you the numbers. I mean, it was just so compelling in terms of the yield you could get, how you could buy the homes and stuff like that, that it started really pushing up. I just got in just before that hit the market. So the price had gone up, but I wasn't able to get the 10% cap rates, and when I invest in the US, I've insisted I want 10%. You know, 6 and 8 is healthy, call me greedy, I want 10%. So we reviewed several US markets, and then we chose Philadelphia as another market to get involved in. In Philadelphia, it's an old manufacturing city that's really in the midst of a significant resurgence, and it's very similar to Hamilton, Ontario. I would sort of describe Philadelphia and Hamilton as sort of similar kinds of cities. Well, the thing I loved about Philadelphia as well, it has great culture, sports teams. It's a 1-hour commute to both New York City and Washington, D.C., and it's got over 50 colleges and universities, so there's this huge injection of all these millennials there as well. And then the other thing too that I noted is just over across the bridge, you go into New Jersey. Property taxes in New Jersey, it's great schools, so families love living there, are just crazy. So for example, if you own a $400,000 home there, you're paying $15,000 a year in taxes. Where in Philadelphia, you don't have great schools, which is why all the families go there. But everyone's downsizing, getting older and stuff like that. What do they want to do? Get rid of the taxes. I think they're all going to be coming across the border into Philadelphia because they don't care about schools anymore. Much lower taxes, and they all want the walkability. You got all the culture, sports teams, wonderful restaurants, things to do in Philadelphia. So I think it's a really good long-term play, and it's got a growing population, particularly among millennials, and it does deliver these cap rates in excess of 10%. So next slide. So Philadelphia is such a different market from Atlanta. So the whole downtown, I don't know if any of you have spent time in Philadelphia, but it's all row houses. There's no such thing as a detached home in Philadelphia proper. And they're all like old homes. It's an old city. So they're all like 70 years old. So now you've got small town homes, 70 years old versus Atlanta, big lots, big homes built after 2000. But similar to Atlanta, we were able to identify a turnkey operator in Philadelphia who would purchase these row houses. Now, a lot of these are dilapidated, tax sales, foreclosures, not in great shape at all. And then they do all the rehab, which would be new kitchens, bathrooms, new wiring, heating systems, and a lifetime roof warranty. So really, they're just keeping the outside structure, but you're getting everything else new inside, which is also great from a tenant standpoint. And then they do the same thing. They'll screen and place the tenants. Again, no evictions. They can't have had a bankruptcy, and they've got to have provable income of 3 times what the rent is. And then they manage all the rent collections, repairs, evictions, et cetera, and they give you a 1-year guarantee on all the repairs. So again, very similar model as to what Atlanta was. And frankly, there's been so many international investors going into the US market because of what it's been. All these companies have cropped up in every city because that's what international investors demand. They need turnkey operations, and they provide sort of from the purchase, the rehab, the screening, putting tenant in place, and then having the complete management after that. And if you get the right companies, they're very good and they do a good job.
Do they still sign a 3-year lease with an option to buy?
Philadelphia doesn't. That was unique to the Atlanta guys with the 3-year lease, and they continue to do it. In fact, my first home that I bought in June 2012 just came up, and the tenant moved out, and they just put in another one with a 3-year lease, and I'm just happy with that. Just turn them over with 3-year leases. It's a beautiful thing.
A 3-year lease or a 3-year lease with a lease to own?
3-year lease to own.
It's still a 3-year lease to own.
Yeah, yeah. So next slide. So in November, just last November, we bought 5849 Warrington Avenue. That's it right here. It's a 1,260-foot, 3-bedroom, 2-bath row house. Okay, so this one was $67,000.
Wow.
But your rent is $950 a month. Expenses are $219. And this one was very fortunate. We had sold a family cottage, Hillies and stuff like that. And we basically just took the money from that and bought this home. And to me, it was a really good trade-off because we had this cottage that all the kids had. All we were doing, we weren't even able to get up there that much, is paying all the maintenance, the property tax and stuff, getting no value out of it. Now we're able to sort of take our share of that equity and buy something that's producing $731 a month cash flow for us. So that's how we finance that property.
dollars?
That's US dollars, yes. That's $731 US, by the way. Okay, keep going. And then also that November we bought 5455 Thomas Avenue. This one right here, $67,000 again. This one's only getting $900 a month rent, but it still throws off $500 a month. And we had to take a little bit of a line of credit on that. It's about $190 a month. So
From our house.
yeah, so that was Philadelphia, the 2 homes. So the next slide. So by January 2015, so this January now, we had 8 homes in 3 cities generating almost $4,000 a month. And that's US. So 1961, the 2 Oakville homes was $656 Canadian. US here in the Philly homes was $1237, so that's $3854. But it gets better. Next slide. However, with the drop in the Canadian dollar, our portfolio is delivering almost $5,000 a month,
Yes.
which is amazing because that cash flow now is $2,451. But the other thing too is because I was financing in Canadian dollars off my line of credit, when I put that financing in my P&L, it was at equal US dollars. But to make it equivalent, I'm actually getting a 25% reduction in my financing in the US because it's done in Canadian dollars. And also then my line of credit interest dropped from 3.5 to 3.35. So with that currency conversion, suddenly the appreciation on your house goes up, your rents go up, and your financing costs go down. Like it's just this beautiful cyclical thing that just throws off cash. It was a beautiful thing. So anyways, the finance savings then, like in US dollars, was another $263 a month on these 4 Atlanta homes, and about $45 a month on these Philly homes as well. So that's what led to the $5,000 a month Canadian of cash flow. Okay, keep going. But I've just talked cash flow now. Let's talk about appreciation. In less than 3 years, we've got a 70% gain on our Atlanta investments. So I tried last year to, I've been trying to get financing as well. That was always my stage 2 because I don't have them leveraged. I've just bought them sort of cash. But I thought at one time, and this was in talks with Peter, that financing is going to open up. And I thought I had someone financing last fall because I was going to finance sort of my 5 homes and buy another 5 in the US. It didn't fall, it sort of fell through at the end because it was some crazy things happened. But in that process, I had to get all my homes appraised so that they could give me mortgages against it. So I had the appraisals done. So the appraisals that were done in November 2014 on my Rivercrest home that I paid 102 came in at $133,000. That was the new appraised number. This went from 84 to 115, 86 to 120, and Shadowbrook, which is a big area, went from 111 to 158. So suddenly now, 2 years later, my homes that I paid $383 US are worth $526 US. But it gets better. Now because of the Canadian dollar, now at 80 cents, not at $1, it's worth now, what I paid $383 is now worth 658,000 Canadian. So literally, that's a $275,000 equity gain, never mind the cash flow, in less than 3 years.
Great timing.
Okay. So the total portfolio has appreciated by almost $500,000, $450,000. The 274 I told you about in Atlanta. Normandy now, those townhouses that we bought for $427 2 years ago are going for over $500 now because people are really starting to jump into that. That's up about $80,000. Garden Drive, which we bought pre-construction 321, is worth about $389 now. That's up 68. And then these Philly homes, which I still bought at an 88-cent Canadian dollar at the time when we bought it, and it dropped down to 80. It's actually at 82 today. Is up about $23,000. So that's $448,000 gain. And then the next slide. Why we took the plunge. So let's go over it again. Property appreciation in the last 36 months or less, $448,000. In addition to that, the cash flow that's thrown off in that time period has been $80,000 Canadian. The mortgage paydown's been about $14,000, and then the tax savings on depreciation, I assumed about a 30% marginal rate, saved about another $10,000 in taxes for a $552,000 gain. So that's not bad for 36 months work, or a little bit less than that. But here's the beautiful thing. With that asset base in place now, if you even just assume a 4% increase on the US market and the properties I have, going forward, that should still be another $68,000 a year of just equity appreciation. You've got a cash flow, if you assume 80-cent Canadian dollar, it's up to 82, so it might be a little bit less than that, of $60,000 a year. My mortgage paydown will continue to be about another $11,000 a year, with this tax savings about 11. So literally that asset base now, without doing anything, is creating about $150,000 worth of value a year. That's the power of real estate investing over time. Now, granted, I got, in a lot of ways, super lucky with the Atlanta properties. Like, that was just a unique moment in time. But having said that, next slide. Oh, sorry, before I get to that, let me just talk about sort of what our next steps are now. The next steps, Hill and I are planning on turning that 74 Normandy townhouse in Oakville into a furnished short-term rental for executives, because there's such a lack of that kind of inventory, and they'll pay $5,000 a month for that. So that'll create about a $2,500
We have somebody in place now.
cash
The
flow,
next person lined up.
a month if we do that properly. So we're in the process of doing that.
Brilliant.
And I'm in the process of refinancing the current US properties to buy another 5 Philadelphia properties this year. Now this is using US money. It'll probably be at about 6% mortgage rate. It'll be about a 30-year mortgage. But when you're buying properties that are at a 10 or 11% cash flow, you're still making 4 or 5, and you're getting all the benefits of appreciation. And I think Philadelphia is going to continue to do well into the future, and you'll still get the mortgage pay down as well. So that's sort of the next steps as we continue to assemble this stuff. And then the next slide. So my point is if we can do it, 3 years ago, we hadn't done anything either. All we had was a paid off house and just said, let's just take some steps. And they say the best time to invest in real estate is 20 years ago. The second best time is now. So, I think you have to be smart about it. You have to pick in the right areas, and you want to make sure, and I'm a huge fan of investing for cash flow, so you're protected in case something happens. But I still think it's a huge thing. So it's never too late to start, even if it's with one home. So I'm thinking even in southwestern Ontario, you can still pick up nice homes in the outlying markets like Barrie and North Oshawa and Brantford and Cambridge and Hamilton, which are sort of the areas, for around $310,000. You can get about $1,700 a month rent, and even if you assume a 3% appreciation going forward, just something like that, just sort of steady, will build about $200,000 in equity in 10 years. And you're sitting there saying, that's, you know, sort of the not get rich quick. But just having that in place and doing it, in 10 years, who couldn't use $200,000? You can sell the home, it'll pay for retirement, it'll do things. So I know for a lot of people it might seem like, oh, I don't have the time, I'm too busy, you know, is this really worth it? If you really focus and do it right, the benefits that it can give you 5 and 10 years down the road can be huge. So if you need any advice or help getting started, you know, please let Hillary and I know. Always glad to share what we've learned. We're still just sort of figuring it out as we go along, but we've learned a couple things along the way, and that's sort of our story to maybe help inspire you to do some things if you haven't. That's it. If you have any questions,
Questions?
yeah.
I'm sure we have lots of
Capital
questions.
gains, how does that,
One? Okay,
how is
Laura,
that going
then
to
Bonnie.
affect? Oh, sorry, I'm sorry.
She jumped, let her go
I'm sorry.
first.
How does capital gains affect you?
How does capital gains affect me?
Will.
I think in the U.S. it's a straight, like first of all, I'm not planning on selling anytime in the near future, so by the time I have to worry about capital gains, I'm not going to be that worried about it. But I think it's about a 15% capital gains tax. But the thing about the U.S., but if you don't sell and take the cash, you can do an exchange if you know what you're going to buy within 6 months. So you can sell and buy other assets. You can't do that in Canada, but in the U.S. you can, and you wouldn't pay capital gains. So my understanding is you've got tax harmonization, so I think it's sort of a flat 15% tax in the U.S. And then depending on what your marginal tax rate in Canada, when you claim that income, you know, if you're in a lower tax rate, you might pay nothing. If you're in a higher, like 40%, you may pay, well, the highest you would pay in Canada is half of the highest margin, which is about 25%. So you may pay a little bit, but it's not super significant.
And you used realtors when you bought all these properties?
No, I use the turnkey because basically they have a whole turnkey system where, like this Philadelphia guy, he's the biggest cash wholesale buyer of properties in Philadelphia. So he pretty much gets first dibs on everything, and they buy them, some through realtors, but he's just in there, foreclosures, tax sales, wherever he can get the inventory. Then he's got all the construction teams that just go through and rehab them, and then sell them to people. So,
Thanks.
yeah. Laura?
Mine was about the turnkey. How did your research work for finding that person?
How did my research?
Yeah, like, so you have them for Philadelphia, you have them for Atlanta.
Yes.
What are you doing here? Are you doing it yourselves, or are you?
In Canada, we are doing it ourselves just because it's right in the neighborhood.
Right.
But I don't do, I'm horrible with,
But we have found somebody, basically, one of the streams of income in Canada that we want to do, because for us, being freed up to do other things, travel and mission work and other things is important to us. So I found a good friend who's going to manage our executive rentals. So we have like a network of 400 Royal Page agents. They're always saying, we're looking for short-term rental, you know, furnished rental, 3 months, 2 months, whatever. So we'll use that. And then he's a handyman, and she just loves to like an accountant. She asked me to help. So we're gonna pay her, so we'll be traveling, doing our stuff, and then they're gonna do that. So that's our next step of not really gonna be around.
but if you wanted to, even in Ontario, I think, you know, for no more than $100 a month, you could get complete property management per home, if that's what you wanted to do as well. So,
I
yeah.
have 2 questions. One, did you buy them in an LP? Or how did you structure that?
So what's happening is I bought all of those homes in Hillary's in my personal name right now.
Okay.
Because I didn't know what sort of the future was going to hold. I wanted to keep it because I didn't know if people would have issues buying in an LLP. It's easier to get mortgages in your own personal name. The financing I'm working on right now requires that I do purchase it in an LLP, which I will. But in Canada then, so I've got an accountant in Florida working with me that an LLP will own the LLC, so that I can continue to get the tax harmonization in Canada. Because there's a funny thing in the tax code that if you just hold your property in an LLC and that's it in the US, you don't get the benefits of the tax harmonization, and you'll probably be double
You will be
taxed.
double
You will,
taxed.
well, if it's an LLC, not if it's an LP.
You want to
Correct.
stand for?
So
Limited partnership.
versus a limited liability
corporation.
company. So I'm going to have the limited
Thank you.
partnership own the limited liability company. That's the
Good.
way it's going to be
Good.
structured. That's what I'm doing. Yeah.
Excellent. And I just wanted to say, I just happen to have this in my, because I found it in my mailbox when I was leaving the house this morning. I have a check for $3,650 from one of my Florida properties for 1 month. And I'm getting this twice, every month.
Yeah,
My
beautiful.
property's in Florida.
They don't just deposit in
this
your
is-
account? They send it to you?
No, it has to be this way because it's a banking thing because my corporation here owns the LP and it can't be transferred from the States unless I open up a US account. And if I open up a US account, I have to file differently, so I chose to have him send me the checks.
Okay.
Yeah, but I just wanted
Yeah.
to, this stuff was
Thanks.
pretty cool.
Yeah. Peter?
I'm just gonna go up here, because I just wanted to,
Yeah.
I don't wanna have my back to people. So, first of all, I wanna commend,
Yeah,
Hillary and Wade.
absolutely.
I think that
Really
they
good.
are awesome, in terms of taking action, because
Yeah.
even though I teach people and I train people, the reality is.
I think this is my turn to sit down and.
No, I want you to stand up here. I say the clubs,
Good job.
the reality is, and this is what I found out, this is inside information, of all these clubs, real estate investment clubs, and all these seminars you go to, and I'm a seminar junkie, and you think you already know that. However, that being said, I have found out that 5% of the people actually take action.
Right.
That's it.
Absolutely.
Now, here's another thing. What percentage of people are actually financially free on the planet? It's the same 5%.
5%.
Do you think there's any correlation? How can you become financially free if you never take action?
Yes.
It's not going to happen. They've taken super brilliant action. Michelle's taken action. I know others have taken action as well. The ones that do are going to be successful. I want to say that on the coattails of what you were doing, I've been working on things in the background, and I didn't. We just briefly talked about it. You missed that section
Yeah.
with the developers.
Yes.
Okay, so now I'm a developer. Okay.
Okay.
So now and now I'm partnering with people, and we're doing. Actually, we just did a project just this week in Atlanta. Okay, and it's hundreds of units. Okay.
Okay.
So I'm going to be talking about that at next month's meeting, the workshop, and basically, I talk about cash on cash. Remember when Wayne and Hillary mentioned about cash on cash on the cash flow, and you talked about you want to get
The cap rate.
10%.
Yeah.
Okay. Well, ours are getting more than 10%,
Mm.
but only because of the economies of scale.
Exactly.
Right.
You can't get that on single
Multi-res.
families.
It has to be
You need
multi-res.
you need economies of scale. So we've got these projects in the pipeline. This one we just closed on Monday this week, and so I'm going to be offering it to us. We're going to like those ones that we have in the pipeline, but we're going to go actually drill through it. So just another option that you have
Yeah.
to get cash flow coming in. And by the way, folks, it's U.S. cash flow.
Yeah.
How many people want U.S. cash flow per month? Or per quarter, or per year?
Yeah, yeah.
And we're talking positive cash flow, not negative cash flow.
Yeah.
Just in case anyone was wondering, okay?
And
All right?
there's another level too, if you do this in a corporation, like I'm lending my American
Yeah.
properties, money from my Canadian corporation, I'm
Yeah.
keeping it all in the family.
Yeah.
I'm charging myself 8% through my corporation, so all that cash comes back to me.
Yeah,
Just like I would pay somebody else in the States, right? And if I could get that kind of financing in the States.
right.
And if you keep it that way, you even have another level of revenue stream.
That's true. And what Michelle's talking about, just, like people, you don't need to know what she knows about that. You can hire tax specialists, which we
Yeah.
already have. They can
How do you
handle all
think I
that for
found
you.
out?
Oh, yeah, no, that's what I'm saying. That's what I'm saying. It's like driving a car. You don't need to know all the moving parts. You just need to know when it needs servicing, you take it to your trusted mechanic.
Yeah.
Yeah.
So the same thing with your taxes. Because you could do a lot of things to actually generate even greater returns.
Mhm.
We're talking about net, because it's not what you gross, it's what you net.
Yeah.
Right? So it's just awesome, it's really exciting, and I just love it when I see somebody actually taking action. So,
Yeah.
awesome.
No,
And
no,
Dan,
no.
you were at the event on that Sunday?
I just
And
wanna say
what'd you
one thing that I've learned, and like for you, you're looking at 10% return, I'm not in the same, I don't look at that, I say 8% is enough for me.
Yeah.
Because I'm looking at it in a different way. But number one, if you guys are gonna take action, 5% of you that are gonna actually take action on this, first find an amazing property manager.
Absolutely.
Yes.
Number one.
Absolutely.
You got that down, you pretty much have everything else
Yeah,
covered.
Yeah.
yeah.
That
And
is
and buy in the
critical.
right place.
Yeah.
Well, of
Yeah,
course,
yeah.
location, location,
Yeah,
location.
because appreciation is the big win in real estate.
Yeah.
I mean, the cash flow and stuff is nice, but yeah.
Mine is location, cash flow, condition. Those
Yeah.
are my three in that order.
Yeah, well, I mean, all those things are important, and in fact, the matter is, I mean, it's like a buffet, right? When they're all positive and they're all gonna help you one way or the other, these are not negative calories, these are all positive.
Yeah.
Yeah.
Whether it's appreciation, debt pay down, positive cash flow, tax benefits, they're all positive, they're all
Yeah.
gonna build your wealth.
Yeah.
Go ahead, Cynthia.
I guess it's a question for both Peter and Wayne. If you were starting today, given the difference in the Canadian dollar, and you had $200,000 Canadian cash sitting there to get started, would you still invest in the US market?
Absolutely.
I would invest in the US market in a heartbeat because I know what the next 15 years are forecast at, and I know the productivity of the GMP.
And here's
So
the thing,
that's
too,
for the
even-
GDP. It's one term, if I could just say, it's one-term pain for long-term gain. And basically, if you have
That's a good way to
something,
put it.
if you have something that's gonna pay you perpetually, then when's the best time to get on the plane?
Yeah.
And I just wanna say, for those of you who are even more adventurous, Ecuador is an amazing place to invest right now, so if you might wanna go visit. It's got incredible growth potential.
Mhm.
So, like, they're now